Deckers Brands is trading under $80, down 65% from its high in January. It's the company that owns Hoka and UGG shoes, trading in the US under the ticker DEC. Can we make money investing in Hoka? Is $80 low enough, or how much should we pay? In this video, I will answer those questions with a super secret system that never fails.
Sure.
But we will also do it in a quick, practical and entertaining way. I hope I made myself clear, even if my picks are always right.
Not really.
This is entertainment, not financial advice. A couple of months ago, I made this video. After a week thinking about shoes, I've decided I'm not going to enter any of these stocks. None of these footwear stocks is better than Google. Google was a better buy than the entire shoe sector, and guess what? The forecast was right.
And lucky.
Google is 37% up, while shoe stocks like Deckers, Nike, On Running are all bleeding red. That's why we are here today, because now, with Deckers down and Google up, the entire situation has completely changed. Let's look at Deckers' bullish points. Hoka brand net sales increased 11%. UGG brand net sales increased 10%. Revenue from two huge brands, two channels, wholesale and directly to consumer, domestic and international, means more stability and less risk compared to other shoe stocks. Top tier operating margins of 21.5%. Hoka gained 2 points of market share in the overall US road running category. The valuation is so low, but I will show you in a moment comparing it to Google and other stocks. First, bearish points. President Biden wearing Hoka. Tariffs impact to be approximately 150 millions, resulting in price increase, resulting in more cautious consumer, resulting in soft outlook for the next year.
Not nice.
Not nice. UGG sales 10% decline directly to consumers. People prefer the multi-brands physical shops than a sold-out e-commerce. What a surprise. Other brands like Hanu closed, while Tiva and Sanuk just don't sell. So, Stefano Carotti, just after 1 year as Deckers CEO, is facing some big challenge. Is he capable or not? To be honest, the more interesting part of Deckers, for me at least, is the low valuation, and I'm about to show you the super secret investing metric that explains everything. But first, a quick favor. My last video got 1900 views, but only 59 likes. That's a 3% only view to like ratio. Are you like stingy or my video sucks? It costs you nothing and it helps me out reaching more people. Please click. Finally, let's geek out with my main metric, today's price compared to 5 years forward earning power. The lower, the cheaper. The higher, the more expensive. Let's compare Deckers with a bunch of other companies. Google, Amazon and Microsoft are all around 17. Visa, MasterCard at 16, Salesforce at 15, Apple at 22. So we have big company valuation around this area is the current fair value for mega cap and big stocks. Generally, we don't want to buy companies that are on their right. We would be paying more for something that's probably riskier. For example, Netflix and Figma at 25 or Reddit at 29. Great companies, but riskier and more expensive. I like to fish for company in the left cheap area. For example, Meta is interesting at 12 or Adobe at 12 as well. Last week we talked about PayPal because it's at 9. And this week we talk about Deckers because it's around 8. Assuming 7% revenue growth, DEC is half price compared to Google or Amazon. That's how cheap it is, but please do not invest only based on this metric.
Why?
Because risks are not included. For example, shoes and fashion have a weak moat, so Deckers' business model is clearly riskier than Google or Visa. It should be cheaper, but in my opinion, it should not be half the price compared to earnings. So, to conclude, Let's go back in history. We can see that in 2012, Deckers crashed 76% in 1 year and then recovered. In 2015, it crashed 60%, again in 1 year, and then recovered. Now we are down 65% in 10 months. My guess is that we are not far from the bottom. Deckers is trading at unreasonably low levels, and I'm seriously considering opening a position with a target price of at least $125, but probably higher. Deckers is not the only undervalued stock. PayPal is very cheap as well, but personally this week I decided to buy 3 different companies. Subscribe because I will reveal them in my next videos. In the meantime, you can try to guess in the comments. If you haven't seen it, watch the PayPal video next. Thanks for being here until the end. Peace out.